Hi, I'm Steve Van Metre. Welcome to your weekly economic update where we take about 30 minutes on every Friday, take a deeper dive in the economic data and try to make sense of a stock market that, once again, really not making a whole lot of sense. I mean, after all, how do you get a week-long rally on, we have threats of tariffs. Well, we actually added tariffs. Let me say not threats. We tariffed India. We're threatening to tariff Mexico. The tariffs on China there was some more that went into effect. We had already said we were, but the drop dead date hit. They went into effect. China, said, okay, yours are going into effect. The ADP payrolls came in weak. There was a crude oil inventory build, and the Nonfarm payroll report was a dud. And investors just can't get enough. They just, good, we'll buy some more stock because the Fed's going to rescue us. The problem we have with investors, when you go on these, 8 to 10 year long bull markets, is they think it's okay to jump out of an airplane without a parachute. Now, I presume that you would never think of doing that, and I would never think of even getting in a plane with the intention of jumping out of it, but you might. I wouldn't. That's just not my thing to do at all. But the notion that if you did jump out of that plane, that the Fed's just going to catch you if something went wrong is ridiculous. And so investors right now are investing without a parachute. They don't own U.S. Treasury bonds. They own high-risk bonds. They own high-risk tech stocks. They are all piled in the riskiest stuff because they now believe, just like they believed in 1999 and just like they believed in 2007, that I don't need to protect myself because if I fall, if I'm coming out of that airplane and my parachute doesn't go off because I didn't pack one, it doesn't matter. The Fed's somehow going to zoom in, Superman, and catch me and take me back up. In fact, I'll even be better because the plane will go higher and the Fed will just take me up to this higher level. So I don't have to have any insurance in my investments or anything else. And that is a foolish, foolish, foolish mistake. Because again, as I've said before, there's never been a monetary tightening cycle that hasn't led to at least a soft landing or a market correction, or in this case, what we're going to see is a much worse recession. And I don't get it. Because when I look to invest, let's just say I was looking to buy a rental home, and I'm not at all interested in being a landlord, but if I was, and I'm not, I would want prices to be really low. So I could say, gee, the price of the house is X, my mortgage payment presumably will be Y, and the expected rent is going to be greater than my mortgage and my expenses. But right now, people don't care. They don't care that valuations are ridiculously high. They don't care that corporations aren't making as much money. They don't care. All they care about is the Fed will somehow make the stock market go higher, and I don't want to look like an idiot for not buying stocks at the peak because this peak is nothing. They're going to shoot this thing to the moon. Now, historically, there's some truth to that because if people actually understood what inflation is, money printing inflation, not consumer price inflation, which is what we base everything on, if people understood money printing inflation and they understood the laws of our country, they would realize that that is not a possible outcome. It's just not. We have laws that say we cannot blatantly inflate our currency. We can't do it. And so when you understand we have a debt-based economy, which is a natural move to deflate, that's what debt-based economies do. They naturally deflate, which is why we keep pumping them up after a recession. See, if our economy just inflated like a balloon, we wouldn't have to worry about it because it would just inflate, but it deflates naturally. But everyone they keep thinking inflation is coming and they keep being wrong and they buy stocks at the wrong time because the market is really good at drawing people in. And let's look at this week. What happened? Earlier this week, the media started, the financial media, which is manipulated by the most powerful investors in this market, the wealthiest and biggest and most powerful. And what did they say? Oh, don't worry, if there's a bad payroll report, the Fed will be forced to ease. Now, nobody knows that for a fact. The Fed did not come out and say, hey, if Friday's payroll report is garbage, we're going to lower interest. They didn't say that. They didn't say that at all. Yet that's the narrative right now. That's the belief, is that the Fed is going to bail you out for not packing a parachute. It doesn't work that way. there's at least an 18-month lag between when the Fed makes a change to monetary policy and the economy feels it. And the more debt that we stack on, which is insane, we're stacking on tons of debt, the longer that lag gets. So what happens? What happens when the Fed raises interest rates and tightens monetary policy? People don't think it has any effect because the Fed starts to raise interest rates and the stock market still goes up. And they go, oh, well, it doesn't make any difference. And then the Fed tightens some more and the market goes up. And they go, well, see, you don't need to worry about it. And then the Fed does this unwinding their balance sheet thing and the market goes up. And people say, well, look, it doesn't matter. Of course, then why did we do quantitative easing if it didn't matter? I mean, we could go down that path, but we won't. Then we have tariffs and trade wars. And guess what? It doesn't seem to have a big impact because there are lags. There's a lag just between the moment the tariff, like think about this. How long does it take a ship to leave China to get to the United States? It takes like 30 days. There's 30-day lag right there. So you put tariffs on and nothing bad happens. And people are like, well, that doesn't matter. Well, tariff some more people. And that's the danger of what happens. So the smart money, as I wrote about this week, and I've got something really cool coming for your Friday. Next Friday, I'm working on today, and I'm going to tease you as we go through we're going to look at the charts, and then next week when you read, you're like, that's what he was talking about. Now I've lost my train of thought. But anyways, so what happened this week is the market or the financial media went out and they told people, don't worry, if things go wrong, the Fed's going to ease. And the problem with that is, again, these monetary lags. Even if the Fed eased, it won't make a darn difference. And that is why when the recession hit in 2000, recession hit in 2008, the Fed did ease. Did it stop it? No, because it can't. It's literally like trying to catch a speeding bullet out in the middle air, and as it's flying by, you can't do it. It doesn't work. But yet now everyone's speaking on behalf of the Fed. Fed has to ease, Fed have to ease. Well, the Fed probably isn't going to because they've already said very clearly. Now they might. I could be totally wrong. I mean, they might. They could totally surprise everybody. It wouldn't matter. But they actually want unemployment to go up a little bit. You're like, wait a minute. They want unemployment to go up? Yes, they do. Because they think unemployment's too low. And they think low unemployment equals high inflation. It doesn't. But that's what they think. They actually want unemployment to be up like in the low 4s, not at 3.6 where it is today. So you have a challenge. You have unemployment running at 3.6%, very, very low historically. You have unemployment claims, or I guess that would be the proper term for it. Unemployment claims are real low. Why are they low? Because people that retire don't draw unemployment benefits. They retire. Go figure. I've said that before. And so the Fed's going to look at that. Then they're going to look at the stock market and say, well, we jawboned the stock market higher that week and it worked. And when the stock market goes up, consumer confidence goes up. And guess what consumers do when they're more confident? They go down to their local Chevy dealer and buy cars. Or at least perhaps one young salesman who's listening to this is hoping as much. So with that, for those of you who are wondering, I do put some little messages in here from time to time, mainly to the amusement of my wife, who does actually listen to this stuff. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by selling security, financial product instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, my own personal capacity. The opinions expressed in this video are that of my own, do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. Yeah, one week you may not have caught it, but there was 2 little fuzzy purple bumps on your camera feed. You probably didn't notice it, but that was Dr. Purple, my wife's surgical rabbit. He came to work and he was on. Yeah, you probably don't think it's funny. Okay, so let's move off from that. And what did I want to switch over and talk about? Monetary lags. Now let's just go into the charts. Off to the charts we go. Enough goofing around. All right, onto the money supply. I'm sure I'll think about what I wanted to discuss in a moment. The M2 money supply has been rising a little bit, and now we know because the Fed came out with their April credit report, which showed an increase, a huge increase in credit card usage and new all-time high in student loan and automobile debt, and that helped boost the money supply a little bit. We see the 6-month rate of change increase to 2.36, 3-month rate of change 1.43. So if you double this, you get 4.6. So it tells us that the annualized rate of growth should be going up. If you quadruple this, you get 5.6. Wow. So the 3-month rate of change is pretty hot all of a sudden. A lot of borrowing going on in April. I'm not sure what that, we don't see it in this other chart. We'll get to that in a second. Commercial industrial lending is falling. As I said, as the back end year over year data rises, this front end number will fall. Now, I just ran this data, and on the 3-month rate of change is at 0.19%. So the 3-month rate of change is down here right above zero, which is telling us that this thing's about to fall off of a cliff. And we know, because of the core ties to the value of the US dollar and how the stock market reacts to this, that if commercial industrial lending falls off a cliff, well, there's a lot of things that are going with it. In fact, we would probably predict that that is why interest rates are falling. Now, this little bump here in consumer lending on the credit card data, this is record huge. This was the biggest surge. It doesn't look like it on this chart. The biggest jump in credit card spending since November last year. Wow. And the annualized rate of growth has dropped slightly to 4.13, but this is still on a downward trend. This is not good, and it's not good that consumers are charging that much on their credit cards to begin with. The Federal Reserve decreased their balance sheet $4 billion for the week. This process will stop by the end of October, but in the meantime, the Fed is still tightening, in case you were wondering. And bank deposit growth is down to 2.04%, still very weak. It tells us that consumers are not saving, and they're probably dealing with high consumer prices that are going to get higher. All right, so domestic Midwest hot rolled coil steel. Now, I lived in the Midwest for a brief period, and I still don't know what hot rolled coil steel is, but I'm guessing it's big, giant rolls of steel that come off the press hot. That would be my guess. Anyways, this, like the lumber data and everything else and interest rates, is telling us, and oil is telling us, stock market way too high, or everything else is way too low. You can pick which one you like. If you're invested in stocks, this is too low. If you're in bonds, the stocks are too high. That's kind of what your opinion would be. But looking further at the data, Class 8 truck orders plunge. Looking at percentage change from a year ago, down 71%, courtesy of Wolf Street. This is worse than the what was going to be a bigger recession that China pushed the global economy out of. And you can see this is not a strong indication for truck manufacturers. And this came from Teddy Valle of Pervale Global, which I believe is his investment company or research company, I'm not sure. But anyways, he said in his Twitter post that seasonally emerging markets, and then I'm adding gold, should make one move lower. And you can see I have said there is a move lower. We'll look at the charts coming, and there is your evidence of that. And I think that is it for the charts. Now let's chat about, I'm going to close that out. Let's chat about the tariffs from China. I'm going to get the stuff loaded up here. Not China, I meant Mexico. Something interesting happened today that I did not know was in the negotiation. And President Trump tweeted that said, we are, I hate to say that because he keeps saying that we're going to make these deals. So I don't really know. Obviously, we never made the deal with China. So we'll just go with the fact that he thinks there's going to be a deal made. If it is, and this is surprising to me, he said it's going to involve Mexico buying a whole lot more of our agricultural commodities. Now, from a political standpoint, again, this is not a political video, but because obviously President Trump's role in all of this is larger than life, we do have to get a little political sometimes. But I want you to point out from an investment standpoint that everywhere he goes to China, goes to Europe, Mexico, tariff. I know we don't have tariffs on Europe, but we probably will at some point. It's all about buying our agricultural goods. So if you don't want to make a deal, well, that's too bad. But if you want to make a deal, that's being added in. And I did not know that was his intention with Mexico. I thought this was literally an immigration issue. I think that's what a lot of us thought. And as it turns out, there's more to it. So he said, hey, if there is a deal, they're going to buy more of our commodities. And if they're not, Monday, we will have a 5% tariff beginning. At the moment as of recording, that looks to be happening. Which one you can decide for yourself. Let's look at the Federal Reserve H.8 report. We see mortgage or Treasury agent securities drop by $2 billion. We see mortgage-backed securities drop by $2 billion. And we see that non-mortgage-backed securities, so other loans, increased by $1 billion. So a net drop of $3 billion on the loan side. And this is really interesting because interest rates are falling. And here's what you have to understand. This is the smart money. The banks are included in that because, well, if you go back in time, you find out that's the smart money figured out you can make a lot of money having a bank and you have access to a ton of information. So the banks now are not in accumulating bonds much anymore because they don't need to. They've got what they want. And that's what the smart money does. They buy up a bunch of stuff. They let the news be what it is. And all of a sudden the news will switch. And then they're on the right side of the trade. You'll watch interest rates dump. Their value of their bonds will go up, and they will sell them to the public. They do this over and over and over and over. All right, on to the Nasdaq McClellan Summation Index, or $NASI, if you go to stockcharts.com. And this has been headed lower. And I said when it crosses zero, which it has, it's at minus 331, bad things happen, and bad things haven't happened. So let's go back and look at October of last year where we saw the same thing. And now we all know the stock market did go down, but we may not remember exactly what that looked like. So let's switch over to the S&P 500. And here's October right here. So what happened? That Nasdaq summation index went like this, but the market went down, bounced, and then gave up. Well, look at this. Went down, bounce. Will we get some more of this? Everyone's now talking all-time highs and more. We're hearing 3,000 on the S&P, 3,200. But that Nasdaq summation index does not suggest that that's true. Now, when we get these moves like we did on the S&P 500, these are called markups. So if you ever bought a car and you go there and on the window sticker it has something called dealer markup. I know if you buy cars in LA, you generally don't see it. You buy cars in Bakersfield, some dealers do that. And I really don't like it myself. That's why I don't buy a lot of cars from dealers here. But when you see this dealer markup, it means the dealer, in this case the securities dealer, is saying, look, we're going to let people pay more. We're going to act like there's no inventory, and we're going to mark up the price of these stocks because people want to buy them. And so they did, and it got right up to the January 20, let's see. Yep, right up to the top of January 2018. And now officially stock prices have gone nowhere in 17 months in 1 week, if that matters. But anyways, it crossed over resistance, came back over. Resistance is functionally acting as support, but this is called markup. And so the smart money generally likes to mark up stocks, and they do that to get people to buy in. So you've got this view that the Fed's going to ease. Now, the Fed doesn't meet next week. They meet the week after next. A lot can change, but there really isn't much. The Fed does not react instantly. They tend to wait a few months to see, if a 1 month dip is just a 1 month dip. If the Fed got in the habit of reacting to every little thing, it wouldn't make a whole lot of sense. So what the smart money will do is they will stop selling, let the stock market bid itself higher because there's an absence of sellers, and all of a sudden when people look at the news, right, they're listening or reading or listening to news, it says, don't worry about the payroll report, don't worry about crude oil inventories, don't worry about this because the Fed's going to ease. And then they look to their stock market screen and they see prices go up and they say, wow, I better buy, I better get in this game, and I better get in it quick. But when you look at volume, you see that trading volumes are pretty weak. I mean, look, this is not high volume, but this is better than what it is here. And so trading volume is nothing more than going to the store and watching prices rise. It's just how many people are there buying. So wouldn't it be weird if you went to the store today and saw a price of something that you wanted to buy and bought, and you went back tomorrow, you see the shelf is really not changed much. There's not really anybody buying there, but the price went up. And you go back the next day, the price is up, the price is up, the price is up. You probably wouldn't buy because you'd look around like, well, no one else is here is buying. And they're not restocking it because I could see the ones that I bought. They haven't been replaced. But yet when it comes to the stock market, people look at rising price and they think, oh, that's the answer to everything. They don't care if not many people are making transactions. They don't care. All they care about is price. All right, so let's see what I've got. So we did that. We did the Fed stuff. All right, let's just roll. Oh, payroll report. I knew there was something I was missing. Payroll report. Okay, you're briefly going to see my editing software that is kind of what does it runs in the background, records this, and I upload the videos. So what I do is I download all the payroll data into the spreadsheet that I made, and this column is the 12-month average, this is a 6-month average, this is a 3-month average. Now let's look at the 12-month average, the official 12-month average. Come down here, we'll say 196,000 per month new jobs created. So this is the official number. It was revised. So we had a plus 75,000 jobs created this month, but the 2 prior months were revised down 75. So this is effectively zero payroll growth this month. This column here, column C, is the Bureau of Labor Statistics birth death model. So this is a number of jobs that they fictitiously create each month. And what we can see is, remember the average over here is 196,000. Of that, 82,000 on average jobs were fictitiously created. So that's pretty bad. I mean, that tells us a lot. And so what I did over here is I take this column, subtract off this, and we get the net adjusted number. So the 12-month average adjusting for the made-up jobs is 114,000. The 6-month average is 98,000. And the 3-month average, which should be alarming because when you look at this, you can see a negative, 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 and 1 positive. What this is telling you very clearly is payroll growth is slowing. It's slowing, and people don't know. It's because, the BLS lies to the Fed, and the Fed lies to the public. There you go. And so you kind of wonder why people never figure out when markets are peaking and they're always late to the game, because everybody's lying to each other, hoping that the recession isn't going to happen, that the data isn't as bad as it really is. But you can't have perpetual payroll growth. It's not possible. All right, let's dive into the charts. All right, so we've looked at the S&P 500. 2-year chart, hit resistance. So when it hits resistance, barring something that drives us higher, I love it when people say, well, if we don't tariff Mexico, S&P is going to go to 3,000. Why? We're not tariffing them now. Why is it we threaten to tariff them and then not tariff them and stocks go up? If people are sitting on that much money waiting to buy in the market, why don't they buy in? Why is it going to take that kind of move to get there? I don't know. Let's look at 10-year Treasury yields falling off a cliff. For all the people who did not believe me when I said that yields were headed lower and that this was a gigantic topping pattern, it is. In fact, if we measure this, and it looks like my measurements are fairly accurate now, we could either measure from the midpoint or maybe even all the way down here, but the midpoint 2.6, 3.2, that tells us 0.8 is the difference, and we would need to get down to 1.9 for this topping pattern the way I've drawn it, and I'm not saying I'm right, the way I've drawn it to be correct. Reality is I think this is going to go back below the all-time lows. And this is interesting because we'll see on Monday that the speculators are still very short the bond market, the retail public very short the bond market, and yet interest rates are down. So when all these people start buying bonds, what's going to happen? This thing's going to tank. It's going to absolutely tank. And it's already further low. And you can see right here, it's trying to find support right in this little bit here. So there's not a lot left here. But once it fails through here, then you're back at the pre-election levels, 1.9%. And then when that lets go, because the global economy is weakening, boom, now you've got everybody chasing the bond market because it is in a bull market. I mean, we crossed the 50-day. We confirmed it once, twice, 3 times. Boom, that is a bull market in bonds. We're looking at yields, but we're looking at a bull market in bonds. So let's go look at Treasury bonds. And here we have the 7 to 10-year Treasury yields that are sitting right in this zone of resistance, and they got through it today, and they might bounce back down and reconfirm it. But look, there's not a whole lot left here. there's not a lot of roadblocks. You got the next roadblock is probably up here around 110.50, and then you've got a running shot. The smart money's been buying bonds because when this thing breaks out, I want to show you what happened back in 2011. Here we go. So here, everybody probably thought interest rates were going to the moon like they always do. Smart money buying, and look at here. This is sitting right at resistance. Now there's a little bit of resistance here, but look at this, and then all of a sudden, boom, 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 day after day, rising prices. This is where the smart money makes their money. They drove it up here, and then the public starts to buy in, and everyone starts chasing it, and then they get up in here to this what's called the supply zone, and then they spend from May to roughly May to May. So they spend 12 months selling their positions, and then boom, what happens? Bond prices go down. Then they buy some more, drive it right back up, and then they sell it again. And then they drive it back up and sell it. So you can see right here, this is what we're going to see is a big move like this, because once the inventory is all bought up, there's really nothing to keep this in control. And you have a lot of people that don't own treasuries that are going to want to own treasuries because it's in a bull market. And when bonds are in a bull market, stocks generally break down. Now let's go back to 7 almost 8/1 of 2011. So let's go up here. Here we go. Look what happened to the stock market. Boop. Bonds break out, stocks go down. There you go. Happens every time. Want to know where the market's going? Watch the bond market. It is in a bull market. Let's touch on ag commodities because I do have a chart I want to look at. So ag commodities have been chasing around its 100-day moving average. Like yesterday, they got over their 100-day. Today they got rejected. This is still not a really big deal because long term, the dollar is headed lower. Plus, you go watch some YouTube videos on what it looks like in the farming community in the Midwest. It's ugly. We have the worst flooding, lowest planting, and lowest expected crop emergence, and people still think crop prices are going lower. Temperatures are going to be pretty cold. That's not really great for hybrid crops. But look, you have all this, you have average rain in gray, and then you have above average rain as it scales up. And of course, it doesn't tell us how much. It just tells above average right through the middle here. And this is in the next 6 to 10 days. Let's go to the 8 to 14 day outlook. So weather's finally going to warm up. But look at there's going to be more rain for the next couple weeks. There shouldn't be, but there's going to be rain. And there's already way too much water on the ground to begin with. All right, we've got 2 minutes left. Gold. Let's quick. Oil and gas producing stocks, what did I say? The sideways pattern, don't buy. Sideways patterns are a continuation of the trend. So there you go. Oil and gas producing stocks almost back to their December lows. And clearly, as we know, the stock market is nowhere near its December lows, but everyone thinks this is going up while this is going down. That is not how it works. So either oil prices are going up or broad stock market's going down. Let's take a look at gold. Came back up here to this longer trending resistance level, and you can see when it fails up here, it goes down. And so I don't buy this as a strong level of support, but it bounced up here on some buying. My guess is, again, when it fails here, it's got to pull back. You got to think of the stock market kind of like a slingshot, right? You got to pull it back and go. And if you pull it back a little bit and let go, it doesn't have much firepower. So you got to really pull it back. And that's why I think gold needs to pull back. I really think that that's what needs to happen here. Let's zoom into the 2-year chart. We've got 1 minute left. Silver. You can see silver is flirting around its 50-day moving average, trying to get out of here, out of its resistance zone. But these silver mining stocks, again, this isn't a strong rally. You normally do not get breakouts on a downward trending moving average. Very rare. But let's look at gold mining stocks. They're back at this long trending resistance zone, shooting right across this green line. I haven't moved it, but it's coming up here, finding sellers. Again, my best guess is we still get a revisit of these lows here. Now, how do we know that? Because we can go look at emerging market stocks, which are strongly correlated to gold. They have bounced up. They're stuck right around this resistance level, rejected at their 200-day moving average. And we just saw Teddy Vallee's chart a little while ago that says that emerging market seasonality is lower. And that does validate that we are likely to head lower with emerging markets, which should pull gold, physical gold, and gold and silver miners down with it. Last, real quick, US dollar chart tagged as 200-day moving average. As bearish I am on the dollar, look for the 200-day to hold. I think there's one last push for the dollar. That brings EM stocks down, brings gold down. There's your buying signal. Watch the bond breakout. Again, smart money's buying bonds. The question is, do you own them? Because that's where they're at. Remember, buy bonds, buy stocks when they're cheap, because that's what happens. All right, we'll be back at you Monday. Can't wait to see what the hedge fund managers are up to. It's just going to validate that we're in the right place for when this thing flips. And when it flips, it's going to be big. You'll see. All right, have a great weekend. Bye now.